A company lost more money in 45 minutes than most people earn in 1,000 lifetimes. What would it take to destroy a company that had spent a decade building itself into one of Wall Street's most trusted trading firms? Not a financial crisis, not a hostile takeover, not even a fraud investigation. Just a single piece of forgotten software, silently running inside a system that nobody had checked carefully enough. According to SEC findings, Knight Capital Group incurred a pre-tax loss of approximately $440 million as a result of trading activity that lasted roughly 45 minutes before the firm's positions were unwound. The loss was so severe it effectively ended the company as an independent organization. And the cause was not a rogue trader, a market crash, or a cyber attack. It was a software deployment error, the kind of operational mistake that engineering teams are supposed to prevent. This is not simply the story of a trading firm that made a costly mistake. This is the story of how technical debt, deployment shortcuts, and absent safeguards combined inside a system that nobody fully understood anymore. And that question, how a system can become a danger to the very organization running it, is as relevant today as it was the morning Knight Capital's trading floors fell silent. To understand why the failure shocked the industry, you first need to understand what was at stake. Knight Capital was not just another Wall Street firm. Founded in 1995, it has grown into one of the largest market makers in United States equities, and market makers occupy a position most people never think about but quietly depend on every day. When an ordinary investor buys or sells a stock, they rarely interact directly with another buyer or seller in real time. Market makers bridge that gap, standing ready to buy and sell securities continuously so that trades can be completed instantly. They profit from the narrow spread between the price they buy at and the price they sell at, a business model built entirely on precision, speed, and getting the direction right. By 2012, Knight Capital was handling approximately 10 to 15% of all United States equity trading volume on a daily basis. Millions of retail investors, many without ever knowing it, had their trades routed through Knight's systems. What depended on the firm continuing to function correctly was not abstract. It was the ordinary machinery of everyday investment for millions of people. Its technology was the engine behind this scale. Knight had invested heavily in automated trading systems, algorithms capable of executing thousands of trades per second across multiple exchanges. Speed and precision were not luxuries in this business. They were survival requirements. And for years, those systems had performed well enough to make Knight one of the most respected names in electronic trading. The trading floors had every reason to feel confident entering the summer of 2012. Buried inside Knight's trading infrastructure was a piece of software that had not been actively used for years. The code existed within the firm's order routing system, known internally as Summaries, the Smart Market Access Routing System, which determined how and where orders were sent across different exchanges and trading venues. Within that system lived a dormant piece of code, a function the SEC later identified in its findings as PowerPeg. Engineers had reused the software flag that once activated PowerPeg to control a new, unrelated function in their updated code. On 7 servers, this worked as intended. On the 8th, the one that never received the update, that same flag still meant something dangerous. This is where technical debt becomes lethal. Over years of development, software accumulates layers. Old functions remain present in the codebase, triggerable by their original flags. Documentation falls behind. Engineers move on. The institutional memory of why certain code exists and what it still does under specific conditions fades gradually until nobody is entirely certain what happens when a particular switch is flipped in a particular way. The uncomfortable truth was that Knight's system contained a function capable of generating enormous, uncontrolled trading activity, and it had a trigger that was about to be activated by accident. In preparation for the New York Stock Exchange's new retail liquidity program, a system designed to give retail investors access to potentially better prices on select orders, which launched on August 1, 2012. Knight's technology team needed to deploy updated software across its production servers. According to the SEC's subsequent investigation, the deployment was performed manually across 8 servers. During that process, one server did not receive the new code correctly. 7 were updated. The 8th was not. This is the moment the failure became structural rather than theoretical. The updated code on the 7 correctly deployed servers had repurposed the old PowerPeg flag for its new function. On the 8th server, the one that had been missed, the flag still triggered the old, dormant trading behavior that should never have been reachable in a live production environment. When the markets opened at 9:30 a.m. Eastern Time on August 1st, the mismatch began to matter. Within seconds of the opening bell, the 8th server began behaving in ways nobody in the building immediately understood. The server was receiving order instructions and, instead of routing them correctly, was triggering the PowerPeg function, which began buying and selling stocks in enormous quantities at extraordinary speed. The system was not executing a coherent strategy. It was cycling through orders continuously, repeatedly acquiring shares at higher prices and selling them at lower ones. Because Knight's entire business model depended on getting that direction right, buying low, selling high, capturing the spread, the malfunction inverted the firm's fundamental economic logic with every single cycle. Other market participants began noticing the abnormal order flow before the problem was fully diagnosed internally. Engineers and trading staff could see that something was deeply wrong. Positions didn't make sense. Losses were escalating, but identifying which system was responsible and stopping it proved far harder than it should have been. According to SEC findings, Knight's risk controls did not effectively identify or halt the runaway trading activity, leaving staff to manually diagnose a problem that the system itself was not stopping. The losses accumulated at a rate that simple arithmetic makes devastating. Approximately $440 million across roughly 45 minutes means the firm was losing nearly $10 million every minute the system continued running. According to reporting at the time, Knight had accumulated a net long position estimated at approximately $7 billion in equities it had never intended to hold. When the SEC and FINRA investigated the incident, they found a failure that extended well beyond a single deployment mistake. But investigators weren't simply reading a report. They were trying to understand how a firm of this scale and sophistication had reached a point where a single misconfigured server could cause this level of destruction before anyone could stop it. The evidence pointed somewhere uncomfortable. Regulators determined that Knight Capital had violated multiple provisions of the Market Access Rule, a regulation specifically designed to ensure that broker-dealers maintain appropriate risk controls before providing automated access to markets. The investigation revealed that the organization had not maintained adequate pre-trade risk controls for its automated trading systems. It had not tested the deployment sufficiently before going live. And critically, according to SEC findings, Knight's supervisory systems failed to generate the kind of alerts that might have allowed staff to intervene significantly sooner. The uncomfortable conclusion the investigation reached was not simply that a deployment had failed. It was that the firm's operational risk management had not kept pace with the complexity and speed of its own technology. In 2013, the SEC fined Knight Capital, by then operating under new ownership following its acquisition by Getco, $12 million for its violations. The deployment error was real, but it was a symptom, not the cause. What the investigation uncovered was something more significant. A major financial institution had allowed technical debt to accumulate inside systems that operated at speeds no human could monitor in real time, without building the safety architecture that such systems demand. Old code had been left in production without adequate documentation of what it could still trigger. A manual deployment process had no verification step to confirm all servers had received updates correctly. Risk controls that should have flagged and halted runaway trading did not function effectively. And the speed of automated trading meant that by the time the problem was visible to human observers, the damage was already catastrophic. This pattern appears across engineering disasters in many industries. It is the gap between the speed at which a system operates and the speed at which humans can intervene. When that gap is not managed by automated safeguards, the system itself becomes the greatest risk. And Knight Capital had spent years widening that gap without realizing it. Knight Capital's losses were so severe that the firm could not absorb them independently. Within days, it required an emergency capital injection from outside investors. a raise that effectively transferred significant control of the company to parties outside its existing leadership. The firm never recovered its independence. Knight Capital was subsequently acquired by Getco in 2013, forming KCG Holdings. One of Wall Street's most significant independent market-making operations had ceased to exist as a result of 45 minutes of uncontrolled software behavior. The reputational damage extended far beyond one firm. The incident made the risks of algorithmic trading impossible to dismiss and accelerated regulatory conversations about the automated systems running beneath the surface of modern financial markets. The Knight Capital incident directly influenced how regulators and firms approached automated trading risk. The SEC strengthened guidance around the market access rule. Industry discussions around deployment verification protocols, automated circuit breakers, position limits, and system testing frameworks all became more urgent in the aftermath. What changed was not simply a set of rules. What changed was an assumption. The industry had largely operated on the belief that the firms building the fastest systems were also the firms best equipped to control them. Knight Capital demonstrated that speed and control are not the same capability, and that without deliberate investment in the latter, the former becomes a liability. The 2010 flash crash had already raised questions about automated trading risks 2 years earlier. Knight Capital answered them in the most costly way possible. Knight Capital did not fail because of greed or malice. It failed because a complex system had grown faster than the organization's ability to understand and govern it. The code that caused $440 million in losses in 45 minutes had been sitting inside the firm's infrastructure quietly, waiting for exactly the wrong conditions to align. That is a warning that belongs to every organization operating at technological speed today. The question worth sitting with is not whether your systems are fast enough. It is whether you truly understand what happens when something goes wrong, and whether your safeguards are fast enough to stop it before a human being even notices. Which system do you think people trust too much today? And what would it take for its hidden weakness to become visible? Leave your thoughts below. If you want to understand how systems fail in technology, finance, engineering, and beyond, subscribe to Null Theory, because the weakness is always there. The question is whether anyone is looking for it.